Currency depreciation is a fall in the value of a currency in terms of its exchange rate versus other currencies. Some say that this phenomenon is good for the economy. Others say that it's not. Those who say it's good claim that appreciation, the rise in the value of a currency, is bad for gross domestic product and exports. From this result, that depreciation should be good for both GDP and exports. But is it really? Rise in the value of one currency, with the other currency maintaining its value, must cause depreciation of the first currency. Periodic exchange rate fluctuations are perfectly normal market phenomenon, just like periodic fluctuations of every market price. The problem begins when a given currency loses its value versus various other currencies in a long term. A core cause of this state of affairs is demand for a currency on one hand and the supply of the currency on the other. So, if the currency depreciates, there can be only two fundamental causes. From the demand side, there's no interest in buying given currency. Something makes this currency unattractive and makes people prefer other currencies. The reason currency may be unattractive is a fear of inflation, bad investment environment, a threat to property law, unclear politics, war, and so on. Let us assume that a foreign investor plans a big investment in a particular country. To buy buildings, machines, to hire workers, and to pay them, he must exchange his currency to a local currency of the country he wants to invest in. If he were to see that conditions in this country are uncertain, the law is unstable, war is coming, or the government announces that it will confiscate property, he won't invest there. It's similar with the stock market investments. The people who don't want to buy given currency then lower the demand. From the supply side, either more people want to get rid of the currency, or its supply rises due to its creation in the banking system. Both situations can occur simultaneously. The reason for people to want to get rid of their currency can be, although it doesn't have to be, its excessive creation and as a consequence, high inflation. Money creation depends mainly on the actions of central banks, but the reasons for getting rid of the currency can be different. For example, in times of economic turmoil, investors often seek to preserve value and flee to the so-called safe haven currencies. One of the currencies considered to be safe haven currency is Swiss francs. In this case, investors sell their assets denominated in other currencies and buy Swiss francs. Also, any strong uneasiness in a given country, high inflation, high law volatility, lack of respect for property, or any other systemic uncertainty will cause people to get rid of the currency. Supposedly, the main advantage of depreciation is that it props up exports. Intuitively, this claim can seem true. If the value of a currency falls, prices of exported products become more competitive. Domestic exporters gain from this, and in consequence, the whole economy is better off. This kind of thinking doesn't include a few important matters. First of all, export is not the goal in and of itself. People export goods to other countries not because they like to collect foreign currency, but because they are then able to buy or import something from abroad. Weak currency doesn't help with that. Look at it in this way. When our currency is weaker, we must spend more units of our currency to buy something from abroad. This something was cheaper before. Can paying higher prices for imported goods really be described as a prosperity growth? Secondly, a huge part of exported goods requires the import of raw materials or semi-finished products. For example, if a car company wants to construct and export cars, first it needs to import some of the parts from foreign suppliers, and their price in domestic currency would be higher if domestic is weaker. As we can see, claims that weak currency is good for exports is, in the best case scenario, a big simplification, and in the worst case scenario, a mistake. As we've mentioned, weak currency makes imports more expensive. But what are the further consequences of this fact? Currency depreciation is destructive, mainly for investments. Let's take the US import structure. USA imports more than it exports. As we see, capital goods with industrial goods together make the biggest group of imported goods. At the same time, without these, investments and business development would be delayed or even forsaken. Efforts to marginalize this problem of rising import costs, such as saying, oh, we won't buy luxury stuff from abroad and buy more domestic brands, are just wishful thinking. Global economy is a system of strongly connected vessels. Weak currency may cause those supposed gains from higher exports to be at least partially eliminated by higher prices of raw materials and semi-finished products. But that's not all. More expensive imports would also cause the prices in stores to go up. Producers all over the world are struggling with prices of materials caused by the broken supply chains. Currency depreciation would only magnify this problem. A surge in production costs would cause a surge in prices of final products. In short, currency depreciation would put another brick in the wall of rising price inflation, which affects most of the developed countries now. Finally, depreciation of a currency may influence foreign debt levels and debt service costs. If a private individual or a state take out a debt in foreign currency, depreciation of domestic currency will cause the debt and interest to rise in the domestic currency. To sum up, currency depreciation brings relative impoverishment for the society, which must pay much more for products from abroad. Because a huge part of exports requires previous imports, gains from exporters may be limited. There are also other negative consequences, such as a surge in the cost of production, bigger foreign debt, and price rises. Let us add that weak or strong currency is a market signal when left alone, and it's good to have real information from real prices and exchange rates. The right conclusion from this video is not that we should make our currencies artificially strong when they are weak, but that intentionally making our currencies weak doesn't in fact achieve a goal of helping exporters, although some exporters may gain from this, and additionally causes other problems for the whole society.
Mark is a programmer. He created a mobile app which will make life easier for his many clients. Anne owns a language school, and she developed her own innovative course of study. Carl organizes amazing motorcycle trips to places left out by other travel agencies. Michael owns a production company and would like to show potential customers his competitive advantages. All of them already know their best qualities, but how can they present these qualities to their customers? These entrepreneurs can use the services of our animation studio, Twinmotion Graphics. Dynamic animation is a great way to explain all that your product or service has to offer. Animation will draw in your customer's attention to what you want to communicate, and the message will be clear and easy to understand. Twinmotion Graphics.